This is the Build Wealth Canada podcast, episode number 52.
Welcome to the Build Wealth Canada podcast, where it's all about becoming debt-free, accelerating your wealth, and taking control of your money. Now, here's your host, Cornell Schreiber.
Hey, it's Cornell and welcome to the Build Wealth Canada show. I hope you're having a great new year so far. The podcast is now back in full swing, especially in time for the RRSP and tax season coming up. And today we have author and Canadian investor Larry Bates on the show. Now, Larry is the author of the book called Beat the Bank, where he shows specifically for Canadians how you can build a larger retirement nest egg by switching from high-cost mutual funds to more efficient, low-cost investment products, and how you can do that in a couple of hours a year. He talks about some of the secrets in the investment industry that many Canadians don't know about. He decodes some of the mystery that is prevalent around investing here in Canada, and he provides a simple step-by-step guide to investing, and like me, believes that you don't need to be an expert to start investing successfully. You just need to know the basics. So Larry is a former banker turned investor advocate. He spent 35 years in banking, has since retired from that, and now spends his time increasing financial literacy for Canadians, specifically in the area of investing. Now, to kick things off on a good note, I've arranged a book giveaway with Larry where you can enter for free for a chance to win one of 3 signed copies of Larry's book. Now, this is obviously for a limited time, and the giveaway ends at the end of February 2019. So be sure to sign up now for a free chance to win. And to enter the giveaway, just go to buildwealthcanada.ca/beatthebank, all one word. That's buildwealthcanada.ca/beatthebank. And once you enter it, you'll get a special link as well to the giveaway, which you can share with your friends and family, and that will automatically give you more ballots for the giveaway. So the more you share, the more ballots you get, and then you're basically going to have an even higher chance of winning. So you can choose to do that or not. It's up to you, but that's how you get the most ballots possible. All right? So that link again is buildwealthcanada.ca/beatthebank. And last but definitely not least, don't forget to claim your free 1-year digital subscription to Canadian Money Saver magazine, Canada's largest personal finance and investing magazine. We thank them for sponsoring the show. It's a $20 subscription that you get for free as a Build Wealth Canada listener. And the magazine features Canada's top experts on personal finance and investing, and is a great place to learn best practices and stay up to date on changes that will impact your investments and financial situation for years to come, specifically here in Canada. Now, to get that, all you have to do is open up a free savings account with my favorite bank and the bank that I personally use, which is EQ Bank. Now, the reason I personally use EQ Bank is that they have one of the highest interest rates in Canada. In fact, in all the years that I've been with them, I haven't been able to find a higher interest rate anywhere. Plus, it's free to sign up and keep an account with them, so you're not paying monthly fees like you do with many of the other banks out there here in Canada. And you get 5 free Interact transfers as well every month as a bonus. So because of those reasons, I've been with them ever since they launched in Canada years ago, and it's where I keep my entire emergency fund and all my spending money. And it just, to put things in perspective, at the time of this recording, their Savings Plus account automatically gives you 2.3% interest, while other online banks in Canada are offering a maximum of 1.25%. And if you're still banking with one of the larger banks, then you're probably getting less than 1% last time I checked. So in other words, by using the bank that I use, you're going to pretty much almost double the interest that you're getting from your checking and savings account, and more than double it if you're using one of the bigger banks, for example. So, and you basically get to do all this for free. And this is why I've been using and recommending them for years to anybody that's asked, and even before they became a sponsor on the show. I mean, there's no initial fee to set this up. There's no ongoing fee. You just get that 2.3% for having the account open, and you basically, when the interest rates, let's say they go up, from what I've seen in the past, they will also increase the interest rate. So, from what I've seen, even though the interest rates have fluctuated over the years, they have consistently been the highest that I've been able to find. So that's why I've stuck with them, and it's been great. So now, even if you love your current bank, just for regular day-to-day use, why wouldn't you at least keep your emergency fund and any extra cash that you're not investing in your savings account over at EQ? And then that way you're at least earning over double the interest on your checking and savings account compared to your current bank. And that's actually what I did when I first started with them. And since then, I've actually transitioned to them now being our primary bank. So to get your free account and a 1-year free subscription to Canadian Money Saver magazine, just go to buildwealthcanada.ca/EQ. That's buildwealthcanada.ca, the letter E and the letter Q. Open the free account, and once you're done, forward any email that you get from EQ, just basically any confirmation email or anything at all that you get from EQ that you open the account. So forward that email to bonus@buildwealthcanada.ca. and I'll send you a coupon code that gets you a free 1-year subscription to Canadian Money Saver magazine. So that's a $20 subscription that you get for free. So that link again is buildwealthcanada.ca/EQ to open the account, and then forward me any email from EQ to bonus@buildwealthcanada.ca, and I'll email you the free coupon code to the magazine. All right, so enjoy. Thanks for supporting the show in that way. And now let's get into the episode. All right, Larry, welcome to the show.
Thank you very much.
So Larry, tell us your story and what your new book is about.
Sure. Well, I grew up in the Maritimes. I went to Dalhousie University and then started my career in the investment business and spent 35 years or so in the business, working for a few different institutions, but mostly for RBC Capital Markets. And I spent my career dealing with and advising very large, sophisticated investors in Canada and around the world. I never dealt with the individuals in Canada, but my book is focused on that. And as I was sort of winding up my career, I spent some time looking at how the industry serves individual Canadians, and it's generally not a pretty picture. Most Canadians invest in stock markets through mutual funds. In fact, 5 million Canadian households own mutual funds. Most of the mutual funds sold by the big banks, as well as the industry generally, have very, well, actually deceptively high fees, which mean that most Canadians are taking 100% of the market risk, but only earning about 50% of the market return, with the balance of the return being lost in fees. And that has a devastating result on retirement accounts. And again, most people don't see that. So the book is, first of all, a bit of a wake-up call with regard to that problem, or that shortcoming in the way people invest. And then secondly, provides some investment basics, which, if people take time to learn some basics, and you don't need to be an expert, but learn the basics, and you'll be able to take advantage of some of the great low-cost investing products that are now widely available through many institutions, including the big banks, actually. And those lower-cost products will leave much more money where it belongs, in your pocket. And so the book, the book is again a wake-up call on the lousy, crappy products that most people use to invest, and then secondly a guide on how to switch over into much lower-cost products and significantly increase your ultimate retirement nest egg.
Mm-hmm. And I'm glad you mentioned that 50% number, how close to 50% can actually be eaten up in fees of when it comes to your investment portfolio. I remember when I first heard that, I thought, okay, that's got to be an exaggerated number. That can't possibly be that high. There's no way someone could get away with taking that much of your portfolio. But then I remember actually crunching the numbers myself, because I was very skeptical, and it's true. so I'm glad you mentioned that. And I think if somebody, it's very easy to get, I think, intimidated by these things, and it can be hard, but to pull the trigger because there's so many options, right? But I think that 50% of your portfolio being eaten up by fees, I think it's worth highlighting, because I think that can be a very big motivator for people to actually take action who are still investing in the high cost way.
Well, it's really outrageous. And I've had a couple of people tell me, "Oh, Larry, the biggest problem you have is people aren't going to believe you. Nobody will believe that you lose 50% of your returns." And in terms of, what other product, where else could you find a fee level or a cost level of 50%? It's kind of like if you bought a house and 20 years later you sold the house and you gained, I don't know, a couple $100,000 in increase in house value, and your real estate agent comes by and says, no, I'll take half of that gain back for
Exactly.
me. It's complete madness. And how does it happen? Well, people just don't see it. the industry works very, very hard at making sure that you don't know that.
Mm-hmm. For sure. And I mean, I work with people in the industry, and there's definitely, we get questions quite frequently, and people will say, well, I'm not really interested in this DIY low cost investing thing because I don't pay my financial advisor anything. So why should, I don't need to cut my cost because I'm already getting it for free, right? And so that is obviously a very, very big flag because nobody works for free, especially in this industry. Right? And so, if you feel like, okay, I don't have to think about this because I'm getting it for free. Well, the truth is you're not. You just don't know about those hidden fees. And then the 50% that we're talking about, that's actually hitting you right now, probably as we speak.
Well, just think about it. I mean, if you just take that impact of 50% of your return is lost in fees. So if you can find a way to largely eliminate those fees, not totally, but dramatically reduce them, you can increase your returns significantly and almost double them. Not by taking more risk, not by buying like crazy stocks at the volatile and startup companies, whatever. Simply by using lower cost investment products and services rather than typical industry mutual funds, and that is it's not that complicated. You don't need to be an expert. You just need to learn a few of the basics. And that's what the book is about. Mm-hmm.
That's great. Yeah, I mean, I think there's a common misconception that you need to hit some home runs in the stock market in order to, let's say, get a 7-figure portfolio, right? Or you have to work for some company and, like the next Google, and you get stock options and you sell it, and now you're a millionaire that way. But the reality is that you actually don't need to do either of those things. You can just invest consistently, with a high enough savings rate, and you can actually get to that 7-figure portfolio without. It's just not as difficult as appears at first glance, and it doesn't require as much luck as appears at first glance.
It doesn't require any luck, really. It requires discipline, patience, time, and again, keeping your costs low.
Mm-hmm. Now, what inspired you to write the book? I know you had a pretty interesting. I mean, I've heard the story before, but I think it's really interesting for the listeners. Can you share us kind of what gave you that push to write this and educate Canadians on this?
Sure. Well, I was sitting on the trading floor in one of the bank towers downtown about 5 years ago at sort of the tail end of my investment banking career, and I got a call from my sister from New Brunswick, and she said to me, "Hey, Larry, all we hear about is how well the stock market's doing, but this bank mutual fund that we've held for 15 years hasn't done very much, and we don't understand why. Can you have a look?" So I quickly Googled it, and I said to my sister, do you realize you're paying 2.3% in fees? And she said, we're paying fees? It's kind of like the person you mentioned earlier. She wasn't really aware that she was paying fees. And I said, no, you're paying 2.3% a year. And she said, you mean 2.3% of our returns? And I said, no, 2.3% of your total investment amount. You're paying that away every year. If you've done that for the past 15 years, that means that 35 or 40% of your money is gone. And my sister was shocked. She had no sense of that. She wasn't aware of the fees. She certainly wasn't aware of the impact of those fees over time. And she and her husband, they worked hard. They're middle-class Canadians. Like most people out there, every penny of their retirement savings is important to them. And she felt like she'd been misled, and technically, perhaps she wasn't. I mean, I'm not saying that she was lied to by the bank, but the bank certainly didn't explain the impact of those costs that they were extracting from her retirement account silently every quarter or every year or whatever. And I just felt, boy, here I am, working in this pretty good job, having had a great career in the investment banking business, driving my BMW. And here's my sister down in New Brunswick getting kind of shafted by by the advice that she received to buy these expensive mutual funds. And I felt I didn't feel good about where I was working. I thought, this is really crappy. And that's really the short story as to what triggered me to go down this path of writing this book and trying to help average Canadians learn how to the simple steps to building a bigger nest egg by using smarter, lower cost products.
Mm-hmm. Now, Larry, apart from writing this book, you're retired now as well, right? Or we'll call it retired, even though you're working on the book, right?
Yeah.
Yeah. It's always a funny term with the retired, I find, because it's, just because you're, it's like, I find, at least most people I've talked to that are retired, they actually still do things to keep active that 1% would consider as work, but they don't consider work because it's enjoyable. Like in your case, right?
Exactly. I'm
right?
very busy.
Yeah.
With the book but I'm retired from my main career, certainly. Yeah.
There we go. Yeah. So that's a good way of putting it. Yeah. So now that you're, I'll call it retired. Right? Now that you're retired, what do you personally hold in your portfolio? What kind of investments have
sure.
you
Well,
I
really three components: a variety of blue chip Canadian stocks, and I have to confess, there's probably an overweighting in Canadian banks, because I think that they'll continue to do well. As they have. So blue chip Canadian stocks. And the second piece is mainly most of my U.S. stock investments. The great majority are just through simple index ETFs, which are very low cost. And then the third piece is GICs. I don't actually own bonds. I prefer owning GICs, because the yields are as good or better than bonds, and I prefer shorter term fixed income investments, like these or short term bonds are I like as well. But I just prefer GICs because it's simple, the yields are good, and I'm comfortable with the risk.
Mm-hmm.
Those are the three components I have.
Interesting. So it sounds like I guess I'll call you a hybrid investor, right? Where you're not only passive index ETFs, you're not only stock picking, you're doing a bit of a hybrid, right? Like you mentioned the blue chips in Canada, you mentioned the ETFs in the US. So let's talk about doing passive index investing through ETFs versus selecting individual stocks, or doing a combination of both, like what you're doing. What do you see as the pros and cons of these approaches?
Sure. Well, first of all, that term passive, people talk about investing through index ETFs as passive investing. I think it's unfortunate people use that term, because if you're invested in the stock market, whether it's buying stocks directly or through index ETFs, it's not a passive exercise. It's going to be a dynamic investment. It'll be volatile. It'll move up and down, and over time, hopefully, like it always has, hopefully it will continue to trend upwards steadily over time, despite the volatility in the short term. So, but
if I can clarify, Larry, by passive, yeah. I mean more so not having to read the financial statements, the annual reports of a company, and then trying to pick a company that you think maybe, let's say, is undervalued or maybe has high potential for growth, right? So I would classify that as more active, where you're actively engaged in investments, versus passive being more like I think what you're doing with, I'm assuming it's what you're doing with your ETFs in the US, right? Where you have money, you put it into that same ETF every month or however often. You don't, you're not trying to time it and predict the U.S. economy and getting in, getting out, that kind of a thing.
Well, I understand, and I think most people, when they hear passive, that's a negative. People have a negative has a negative connotation to it.
Oh, okay, interesting.
But so yeah, index investing I think makes sense for probably most investors because picking individual stocks is probably beyond the people don't have the time and frankly don't have the skill or the ability to find bargains and to pick the future winners and avoid the future losers. So I think index investing is it's very simple, very easy. It's very, very low cost. For instance, a mutual fund might charge 2% annually in fees, whereas an index fund might charge 1/10% or even 1/20%. So that could be 20 or 30 or 40 times cheaper than a mutual fund. So index ETFs are low cost. That's a huge advantage, and obviously they provide instant diversification. There's lots of different ETFs out there, and you've got to know a little bit about which ones to choose. But they all provide automatic diversification, which is difficult for investors to build by buying individual stocks unless you've got a ton of money, and you can instantly diversify by buying 10 or 20 different stocks. So I think for the average investor, buying index ETFs, low cost index ETFs is probably the best way to invest as an individual if you're going to do it yourself. But let's talk about individual stocks. As I mentioned, my Canadian stock investments are simply individual stocks. But as an industry professional, having and at my stage, I invested over the past 30 years or so, bit by bit, adding and creating a diversified individual stock portfolio. I didn't feel that an index for me, certainly when I started, they weren't around, but limited value for me as a confident, experienced industry professional. There aren't that many blue chip Canadian stocks. That's what I own: blue chip Canadian stocks, the banks, utilities, railways, phone companies, etc. And there's not much value in an index because I've already got the diversification. But again, for an investor who is starting out or less experienced, while you can build an individual stock portfolio, and the costs of doing that through a discount broker are incredibly low. It may not be I think for most investors, they'd be better off sticking with index ETFs.
Mm-hmm. So would you say the main sort of, I guess, con of going with passive, index, or I know you don't like the word passive, but I use it in the context of not actively, trying to research companies, that kind of thing.
Yes.
Would you say that, the main kind of downside of doing, passive ETF investing is that you might earn lower returns than if you invested in individual stocks, assuming you invest in the correct individual stocks, which is a lot easier said than done.
Yeah, I guess so. But
is that really what it boils down to, or is there other pieces you think?
Well, I think that's true, I suppose. But most people don't have the time. As I said, they don't have the skill to go and look at an array of stocks and determine, this one's undervalued, this one's overvalued. Remember, we've got thousands of analysts out there poring over statements. These are professionals who do this for a living, and they're basing their recommendations on all this analysis. And essentially, a stock price reflects the views of all these analysts. So it's quite a stretch to think individuals can go out and beat those analysts and figure out which stocks are better. So I think that's a tall order, and I just think it's so easy and convenient to buy to invest in stock markets through index ETFs. I mean, to say it's a no-brainer might be a bit of a stretch, but relative to picking individual stocks, it is. And so for most people, I think that's a better route.
Mm-hmm. And then when it comes to evaluating individual stocks, I think a common concern that investors have is, what if the stock they are considering is overvalued? So, for example, maybe maybe they're in the industry too. Maybe they have a very big interest in investing in blue chip companies like you do, let's say, but they're concerned. Okay, if I buy into it now, I don't know. How do I know that whether it's overvalued or not? How do I make sure I don't end up overpaying for it? So, when you buy your own blue chip companies, what precautions, due diligence, and research do you personally do before investing and before choosing to invest in any particular stock?
Yeah, I think first of all, great companies the stocks often appear overvalued, but they stay that way over time. So because the companies are strong, their earnings are growing, and they demonstrated a track record, and people believe that they'll continue to do so. So some stocks are overvalued always, and that's fine. But another angle to it is, of course, people get excited about, this year it's been cannabis stocks. Last year it was crypto. Unfortunately, a lot of investors, are concerned about overvaluation because some of these stocks go from next to nothing to huge valuations, which is where most people start buying them because, retail investors tend to be late, and many of the insiders have bought these up and coming stocks for pennies, and they're the sellers, and the retail buyers end up buying these stocks at high prices and losing out at the end of the day. So there's a bit of a whole game around that, which I recommend people stay away from. Just buy quality stocks or low cost index ETFs and sit on them for a long time, and don't worry about it. Forget about the market day to day and what's hot and what's not. Just be a steady long-term investor. That's, I believe, what most Canadians should do. In terms of doing due diligence or research on individual stocks, again, you've got thousands of professional analysts out there who are advising the big institutional investors on what to do, on stock valuations, and essentially, stock prices reflect those opinions. If you see a company that you have some faith in, you think their products are strong, they've got a good client base and longevity and history of doing well, probably the stock price is a reflection of what the true value of the company is. So again, to try to beat or outthink professionals, I don't think it's going to serve most investors well. If you're going to try to build an individual stock portfolio, I would say the way to do it is to do it bit by bit over time. Don't put all your eggs in one basket. Diversify your holdings and add a little bit. Could be every year or every 6 months. Add a little bit to your portfolio, and if you do that over time, you'll be somewhat protected from the ups and downs of, the market might be up 20% one year, down 20% another. But if you're a steady investor over time, those swings won't really have much of an impact on your ultimate result.
Mm-hmm. So I guess you're a believer of the efficient market hypothesis, it sounds like, based on what you said. Would that be fair to say? Yeah, gotcha.
Yeah, largely. Yeah, I mean, obviously there are exceptions, but yes, I'm a proponent of that hypothesis. Yeah.
Interesting. Yeah. I mean, and for anyone who doesn't know what that is, it's basically what Larry kind of just described, where the prices that are out there in the public, the prices are already reflected based on all the latest kind of information. Would that be fair? Would that be an okay definition, Larry, or do you have kind of?
I think that's correct for large blue chip stocks. Mm-hmm. For speculative stocks like penny stocks, mining stocks, crypto stocks, cannabis stocks, etc. Mm-hmm. Basically, the insiders make a ton of money, and the average investor loses. Mm-hmm. So that market is not efficient for small investors. It's very dangerous for average investors. But large blue chip stocks and the market overall, I think those markets are efficient, and investors don't need to be too concerned about, essentially, an individual investor can go buy, RBC shares or Bell shares or Apple shares or whatever it might be at the same price as the big institutions pay. So, the big institutions are the ones who own most of these stocks, it's a great opportunity. The stock market gives average Canadians, average investors, the opportunity to own great businesses by investing in stocks at the same price as the biggest players have to pay. That's fantastic.
Yeah. No, that's great. Thanks for that answer. Now, kind of going back to your retirement and financial planning strategy and all that, how do you manage your own cash flows now that you're retired? So in other words, now that you don't have that income coming in from your job every 2 weeks, what sort of asset allocation or systems or structure have you put in place so that you don't run out of money long term?
Well, that's a challenge for everybody because there's no absolute guarantee that you won't run out of money. Even if you throw all your money into an annuity, for instance, unless it's an inflation index annuity, you still got risk that it's not going to be enough at some point. So this is the big challenge for millions of Canadians, millions of boomers who are approaching retirement or in retirement. How do you make sure you don't run out of money? And it's a real challenge because rates of return are in bonds and GICs are very low, and rates of return in the stock market are uncertain. Over time they've been good, but they bounce around a lot, and a lot of people can't handle that sort of those ups and downs, or can only afford to take a small risk in the market. So it's a real major challenge and a real source of stress for many, many people. What do? I do maintain, as I said earlier, a mix of Canadian and U.S. stocks as well as GICs. But certainly over the last several years, I've increased the GIC component of my portfolios. And reduce the stock portion to give myself some cushion, and to give myself 2 or 3 years of funding available through sort of guaranteed investments, GICs that aren't subject to volatility, so that I'll be able to ride out any short-term market storms that come along, so that I can avoid the worst case scenario that people get themselves into, which is the market takes a dive, it's down 10%, which it is now, or 20% or 30%, it's a really ugly market, let's say. And then they feel they have to sell. They can't stand it anymore. They sort of panic and sell, or they're forced to sell because they just can't take any more risk. That's the sort of worst scenario. And we saw so many people do exactly that in 2008 and 2009, when the market was market crashed, and people just couldn't take it anymore and sold all their stocks. And in the meantime, stocks are up 200% since then, or whatever. And folks just, they sold at the bottom, and really financially suffered as a result. So I think as you get toward retirement or in retirement, you have to have a good chunk of your investments in GICs or short-term bonds or other forms of liquid instruments, cash, whatever, that'll enable you to fund your cost of living over at least a couple of years, so that you're not forced to sell when the market dips and dives.
Now, is there a target date length that you use? So for, like, do you do a 3-year GIC cushion, or 1 year, 5 year? Is there a particular time, a particular length that works well for you?
Well, I think 3 years is a reasonable time frame for sort of cash or GICs in terms of making sure you have that much 3 years worth of expenses covered. But yeah, it's a matter, that's a personal thing. It's an individual choice. I'm more bullish than most people probably are, and more used to the ups and downs of the stock market. They don't bother me as much as they probably bother most people. Really, you've got to find your comfort zone. I think the most important thing is, figuring out how much risk are you willing to take in the stock market, how much volatility are you willing to stomach, and using that as a guide to determine how much of your portfolio to have in the stock market versus super low risk stuff like GICs or short-term bonds. I mean, the stock market over time has produced much higher returns. And I'm 62. Some people think, well, you get to retirement and then something happens. Your investment portfolio turns into a pumpkin or something like that. It doesn't happen. I've still got to invest as though I'm going to be around, 25 or 30 years from now. It's a super long time frame, even though I'm at the point of retirement. So, just buying GICs or short-term bonds, that's not going to do much for me. I'm going to earn, 2.5% or 3%, after inflation eats away half of that. And,
right.
And whatever's left, depending on your circumstances, tax can eat away another half of that. And you're left with virtually nothing, zero return. So, in order to really generate a positive return after fees, after taxes, after inflation, you got to invest in the stock market, which means you've got to stomach the volatility that goes along with that. So it's there's no one answer to the what should you do question. It's based on individual choice, but the most important thing for individuals to do is to gain a little bit of knowledge of investment basics, understand a little bit about how it works, and that'll put you in a position to make a better informed decision, and make the right decision for yourself and your family, and go through life with less stress and less worry about the markets.
Mm-hmm. For sure. And I'm definitely not asking you to, give us some golden, or silver bullet that is the correct answer in every situation and every scenario in front. Because that you and I both know that doesn't exist. And listeners of the podcast also know that doesn't exist, because we've definitely talked about it before. But it is, I think it is very interesting to talk to, especially those who are, did a traditional retirement or early retirement, and see maybe people who have background and expertise in this field, and see, well, how do they personally structure everything based on all the best practices they've read over the years? What did they ultimately settle on in terms of that mix, to give them that, so that to give them that sort of sweet spot for them specifically, where they're still going to get to take advantage of the growth in the markets, but they're also not exposing themselves to so much risk that they're going to have to withdraw during a major downturn, something of that nature. So
exactly, that's exactly right. And I think that can be different for every individual. And if you've got an advisor, they can help you figure it out. And but whether you have an advisor or not, learning the basics, gaining some investment literacy will be a big positive in helping to make the right decisions.
100%. Now, you mentioned the 3 years, how that works well for you as an aggressive, quote unquote aggressive investor, what others would consider an aggressive investor. What how did you settle on that 3-year number? Was it looking at, average recession lengths and things like that? Or was it just more qualitative where that just makes you feel comfortable? How did you come up with that?
Well, I think that's most, over most market cycles, 3 years will take you. Most market downturns last probably less than 6 months, 12 months. Very few last more than a couple of years. So that's so I think that's a 3-year time frame is long enough to cover. Will very, very likely be long enough to cover any downturn in the market. Gotcha.
So is your thinking in the sense of, okay, let's say there's a downturn, it's dropping, markets are dropping for, let's say, 6 months, 12 months. Historically, if things continue going the way they have in the past, most likely, after that 12-month period, we're historically would have started to see the markets recover. And so if we have a 3-year cushion, then that gives us plenty of time for the markets to get back to their previous state. And so now we can start withdrawing from our equities. Is that kind of your thought process there?
That's a good description. Yeah.
Okay, great. And so do you use a GIC ladder for that, or how did you choose to implement that?
I have some term GICs. I also use some cashable GICs. So I've got a mix in there. I don't have a formal ladder, which I think can be that's a great approach for many people. I don't have that strict a process in GICs.
Okay.
But I think again that can be that is a great concept and a great way for people to keep them their GIC investments organized.
Mm-hmm. Gotcha. No, that's great. Thank you for sharing that. It's always interesting, like I said, to hear how others have structured their their retirement essentially. Now, if you were retiring much earlier, let's say you were in your 30s or 40s, and you had enough in your investments to actually be able to retire at that point, would you tweak your strategy a little bit because now there's an even longer time horizon that you have to make sure you have enough money for?
Well, I don't know anybody in their 30s or 40s who is in that position, but if people are, then that's great. But I think the longer your time frame, the more that you would tend to want to be in stocks. I think also the longer the time frame that you have, the more important it is that you if you can rely on your income from your investments, dividends or interest coupons or whatever, to cover your costs. If you've got a very long time frame and you're eating into your principal to cover your costs, then that's a more a risky approach if you're doing that and relying on the markets to market increases over time to keep you on track. It's I don't know how many of your listeners are in their 30s and 40s who can afford to retire, but certainly that's a rare thing.
Mm-hmm. Now, with something like you mentioned like a 3-year GIC, to cover sort of those downturns, do you think that would could still apply to someone that is, like, let's say they held a very high equity portion, and then they had, let's say 3 years, they felt very comfortable with large volatility, the 3-year sort of GIC timeframe that you're using, do you think that could still be useful for them?
Yeah, I think so. Again, it's so many different factors involved in individual decision. How much volatility they're willing to handle. What are their expenses versus their income, and so on. So again, I think the important thing is get comfortable with how how investing works, and then you can make good decisions. But it's certainly tough, as you mentioned earlier, to sort of provide a blanket. Oh, this is the right thing to do, and this is the wrong thing to do.
For sure. Now, for a bond portion of someone's portfolio, what kind of bonds do you recommend? I noticed in your book you were very pro short-term bonds instead of long-term. Can you talk about long-term bonds versus short-term versus Canadian versus international?
Sure. Yeah.
Yeah.
Yeah. Well, first of all, I see bonds, the bond portion of your portfolio, or fixed income portion of your portfolio, whether it's GICs or bonds. That's the wealth protection element of your portfolio. Stocks are the wealth growth part of your portfolio, the wealth building part of your portfolio. Bonds are your wealth protection element. So there are high risk bonds out there, high yield bonds, and so forth. I think for most investors, want to avoid those and stick with largely government bonds, and they're very low risk. They're a bit lower return, but you don't have to worry about picking the right ones particularly. And I recommend provincial bonds like Government of Ontario, Quebec, or BC, or whatever. They pay maybe 0.5% or maybe 1% higher than Government of Canada bonds. So you pick up the extra return for, in my view, not much additional risk. Long-term versus short-term. Again, given that bonds I see as wealth protectors, I think you want to minimize the volatility of the ups and downs in the value of your bonds. And long-term bonds can be very volatile. As interest rates increase, which they have been doing lately, bond prices have been dropping. And the longer the maturity of the bonds you're holding, the more their price will drop as interest rates go up. For example, if you're only a 30-year bond, rates go up by 1%. That bond value may drop by 10 or 15%, which will surprise a lot of people who think bonds are perfectly safe. And so, but short-term bonds, if a 3-year bond, for example, that interest rates go up by 1%, that bond will go down in value, but it'll only go down in value by 2 or 3%. So you got to be a little bit cautious with long-term bonds. I prefer to avoid them, certainly in this environment where interest rates there's more risk of interest rates increasing than decreasing. And in terms of currencies, if you've got some reason to need income in other currencies, then non-Canadian bonds may make sense. For instance, if you spend a bunch of U.S. dollars, if you have a place in Florida or whatever, and you need U.S. dollars every year to finance your costs, well, owning U.S. dollar bonds may make good sense. But aside from that, there's no particular value in Canadians owning bonds denominated in other currencies. Mm-hmm. So for most people, I recommend shorter term bonds or GICs. I recommend government bonds rather than corporate bonds. And I think bonds issued by provinces are probably a good combination of a bit higher yield and very low risk.
Mm-hmm. Now, like you mentioned earlier, you for your personal portfolio, you favor the GICs. Now, mm-hmm. Are there any pros to bonds over GICs? Things that would make let's leave it at that. Are there any? Sure. So you've talked about why you pick GICs, but what about what are the pros to bonds?
The pros to bonds are that the first and most important is liquidity. Most GICs, you buy a 2-year GIC or a 5-year GIC, you're stuck for that term. You don't have access to your funds until that GIC matures. Whereas with bonds, buying bonds through a discount broker or whatever, you change your mind, you can sell them the next day, as long as it's a high quality bond. And either a government bond or even a high quality corporate bond. Liquidity is a big advantage. You can get access to your money by selling anytime.
Mm-hmm. Gotcha. But in your case, you just have some shorter term GICs, and then you kind of cover yourself off that way, as opposed to just putting all your money into like a 5-year GIC or a 3-year GIC, and then that way you're staying liquid.
I don't want to put my money in a 5-year GIC because I'm going to use some of it over the next couple of years.
Exactly. Yeah. And then there's the whole opportunity cost. If rates do go up, well, now you're locked in at these lower rates, and there's also that component, right?
Exactly. Yeah. So I prefer shorter term, whether it's GICs or bonds. I prefer shorter term because I think that the risk. I want safety in my fixed income portfolio. I don't want risk of it going down and by 10 or 15% in value, which long-term bonds can.
Gotcha. And then what are your thoughts or on the criticisms of the S&P TSX, so the Canadian index? And I mean, the main thing I'm talking about here is the sector concentration that it's very much known for. Yes, we can try to adjust our portfolios to maybe offset that a bit, but that obviously adds a lot more complexity to our portfolio. So, is it worth it? We're now incurring more complexity, probably, higher trading costs, all that. Can you take us through it?
Sure. Well, the Canadian economy is heavily resource industry based, and the other big component of our economy, certainly of the stock market, are financial institutions. So, if you invest in a Canadian stock index fund, relative to the global economy, you've got a very heavy exposure to mining, to oil and gas, and to financials, and that sort of flies in the face of the fundamental principle of diversifying. It's not there is limited diversification, or in most people would say insufficient diversification for Canadian among Canadian stocks. So that is certainly a shortcoming of the Canadian stock market, which can be addressed by investing outside Canada. So I think most people who are investing in stocks should have probably at least 50% of their stock investments outside Canada, and our neighbor across the border, the U.S. has the world's largest, most dynamic, most successful economy ever known, and their stock market has tons of diversity in sectors that are severely underrepresented in Canada, like high tech, like healthcare, large manufacturers, large brands, et cetera, et cetera. So I think the short answer is, invest some of your stock portfolio in Canadian stocks through index funds or otherwise, or blue chip stocks, but have a big chunk invested outside Canada, largely in the U.S. and if you want, you can buy global index funds or combination of U.S. And non-North American, et cetera, et cetera. So there's various ways to do it, but if you're going to get real diversification, which is important, you've got to have some of your stock investments outside Canada. Mm-hmm.
And then, in that answer, you touched on the home country bias, right, that exists for most Canadians here, right, about having more of your portfolio in Canada than would be justified if you're looking specifically at Canada's share of the entire world economy. So how, what is the reasoning that you tell your readers or that you believe for having such a, like you said, over 50% you said to have outside of Canada, but Canada's percentage of the whole world economy is much, it's a few percent, right? It's not nowhere near 50. So what justification is there for having such a large portion in Canada to begin with, especially because of the fact that it's also not very well diversified in terms of sectors?
Right. Well, one reason is people understand their home market and their home economy much better than they understand what's going on elsewhere in the world. And I think people can be more comfortable with what's happening here, even if the markets are difficult. Whereas, if you've got your funds invested in the Far East or in Europe or whatever, and there's stuff going on, and the markets are volatile, and there's headlines about crisis here and there, I think people are more likely to be fearful and stressed over that and react badly. So I think there is value in there is home country bias makes sense to some degree, because I think people are more comfortable with investing closer to home with companies that they know, that they actually do business with, for instance, and an economy they're familiar with, rather than being overseas and no understanding of it. So I think home bias is makes some sense, despite the shortcoming of the lack of diversification in Canada. So you've got that's the sort of trade-off: home country advantage versus lack of diversification. And again, I think some investors may want to own a very small portion of their equity investments in Canada, and that's fine if they're comfortable doing that.
Mm-hmm. So is the primary benefit then that you're more likely to keep sort of a cool head, and ride out storms that will inevitably come up in your investment journey, if you are heavily invested in a country that you also live in? So, you hear, sky is falling out in the emerging market space, let's say, right? And so you're saying if you have so much there, you're more likely to maybe panic, do something, like just sell at a bottom because you're so worried and you don't really know what's going on. Versus Canada, you might see the stock market crashing, but then you go outside and you see, well, everyone seems to be working. The companies seem to be doing, okay. Yeah. They're not doing mass layoffs.
You can find for yourself that the sky isn't quite falling.
Right, right.
And another advantage as well is you avoid currency risk, which can be significant. Invest in stock markets, overseas, you're subject to whatever the Chinese currency is doing, or the pound, or the euro, or whatever. So that's another thing that you can eliminate, or that's another added risk of investing overseas.
Right.
So it's just simpler, but again, it's personal comfort level has a lot to do with it. And again, how do you get that comfort level? Take a bit of time to learn some basics. Don't be just don't blindly follow what somebody tells you to do. Learn a little bit about it, and you'll be a much more informed consumer, if you will, of investing products, and be a smarter consumer.
Mm-hmm. Gotcha. And then, when you talk about currency risk, do you go with, you mentioned you invest in the US, do you go with unhedged or hedged ETFs, or do you just invest directly in, like a VTI, for example, like just a US traded ETF that holds the index? What's your personal preference when it comes to that?
I think my personal preference is unhedged. So yeah, and I think that's the right thing to do for long-term investors, because over time, those sorts of currency moves up and down, especially Canada versus U.S. dollar is one of the is less a less volatile currency pair than say Canada versus euro or sterling or yen or whatever. Much more risk there. But no, so I don't hedge my U.S. stock investments, and if I were shorter term, I might, but no.
Gotcha. Okay, no, that's great. Thanks for. Like I said, there's no silver bullet, like we said, but it's always nice to know what you've personally decided to do, because you've been in this for a long time, so there's some good reasoning behind your decisions, right? And you're retired now, right? So I'm sure you've done a lot of research before pulling the trigger as well, right?
Well, one thing I'd say about that is, and again, I'm not a typical investor, but I spend I don't spend any time really looking at what's going on in the market. I ignore it completely because, I'll just give you an example. You know, if you watch BNN or CNBC or whatever, you see people talking all day about what's going on in the market. But next day, none of what they talked about the previous day means anything. It's just noise. So the stock market's up 300 points or down 300 points or whatever. It just has zero impact on me because it's meaningless in the long term. If you look at the S&P 500, the main U.S. stock index, it's averaged up 10% a year over time over the last 20 years, actually probably over the last 60 or 70 years. And yet it's gone through massive ups and downs. The global financial crisis in 2008 and 2009, the dot-com crisis in 2000, the Russian crisis, this crash of 87. What did all those events, what was the ultimate impact of all those events on the value of the stocks in the S&P 500? The answer is zero. It didn't have any impact over the long run. And that's a way of looking at investing that I think would benefit most investors. Forget about the day-to-day noise. It's just noise. It's meaningless. Really, what matters is the long-term growth in the economy and the increase in profitability over long periods of time, over many years and many decades of the companies that you're ultimately invested in. And the market moves day to day are meaningless.
Mm-hmm. Oh, for sure. And one question I just thought of too was, sure. I've heard some people do a strategy where, let's say they're in retirement and they will have a combination. So, I mean, they'll have a big equity portion, but they'll, instead of using just bonds or just GICs, they'll do a combination of the two. Why would someone do that? What are there certain pros and cons of doing that versus going with just GICs or just bonds for the safety portion of your portfolio?
Oh, I don't know. I don't think there's any particular single answer to that question. I think some may want to have liquidity and immediate access to their cash. And in those cases, bonds might be a better choice because you can just sell them and get your cash, whatever the market value of them is at the time. And that other people tuck money away in GICs, and some people just keep their money in their bank and throw them into GICs. Although you should shop around. So no, I don't know of any particular insight I have on that question. I think we talked a bit about bonds earlier. Shorter term, I think is lower risk, but. I wouldn't have a strong view of a big advantage other than the liquidity advantage as between shorter term bonds or GICs.
Mm-hmm. And then in terms of you picking GICs for your own portfolio, is one of the reasons too that you just don't want to have to deal with the impact that interest rates are going to have? And you mentioned before about the relationship between the interest rates going up, bond prices going down, all that. But you can sort of in a way bypass that, right, by just doing GICs, and then you're not worried that much about interest rates. I mean, they still impact you, right, because there's still the opportunity cost if rates go up, and you're locked into like a long-term GIC. But I mean, is that one of the kind of reasons that you decided to deal with that?
No, not really for me. I actually, where I worked in the bond business, and I'm very familiar and comfortable with how bond prices move, so that doesn't bother me. But no, it was just really better value. Really, that's what it boiled down to. Is looking at GIC rates that are available versus the yields available on bonds. It's really as simple as that. GIC rates can be much higher than the rates of return offered on government bonds. Simple as that, really.
Gotcha. That's great. Now, okay, last question. Going back to your book, one of my favorite parts was how you broke down investment portfolio optimization to just 6 core areas to focus on. Can you talk about each of those? Maybe give the listeners a bit of a kind of a teaser for your book, what these 6 core areas are.
Well, sure. It's what I call the wealth formula, and there are 6 factors or forces that will determine the success or failure of every single investment that you make, or every single portfolio that you have, or your RSP or your TFSA or whatever it is. So there's 6 forces: 3 wealth builders and 3 wealth killers. You want to maximize the builders and minimize the killers. So what are the 3 wealth builders? Very simple: the amount you invest, the time frame or your time period of investment, and your rate of return. So that sounds pretty simple. It is. So the more you invest, and the longer the time frame, and the higher your rate of return, the better your result. Now, but what really drives that wealth builder aspect of the formula is the compounding. Obviously, investing at good rates of return over long periods creates this magic of compounding. Einstein called it the most powerful force in the universe. The results can be astonishing, just shocking to people if you run the numbers. And you can see a little calculator on my website which does that. But that power of compounding can produce just astonishing returns over long periods of time. And by the way, Warren Buffett's a brilliant guy and he's made great investments. But the real secret to the growth of his net worth over time is he's been investing for 65 years. The guy's 85. He started when he was 20. He's really benefited massively from that compounding and those 3 forces: the amount of investment, the time frame, and the rate of return. So that's the wealth builder side. The wealth killer side is 3 forces: fees, taxes, and inflation. You've got to try to minimize those, or minimize the impact. We've talked a fair bit about fees. That's where most Canadians really lose out. They're paying stupidly high fees, and the financial institutions will keep charging them as long as people keep paying them, and they'll avoid any discussion of the impact. But so fees are the number one wealth killer that Canadians need to minimize. Second is taxes, and I think most Canadians do a decent job at that. Everybody's familiar with TFSAs and RSPs and so forth, and so those are great tools for minimizing the wealth killing effect of taxes. The last wealth killer, inflation. There's nothing you can do to stop inflation. It's out of our control. The thing you have to do is beat it. And I mentioned it in an example earlier. If inflation is 2%, well, you've got to earn more than 2% just to keep the value of your purchasing power. So, looking at those wealth killers, I mentioned compounding in the context of the wealth builders. And compounding can work in the opposite way too. In fact, it brings to mind Jack Bogle's sort of famous statement. He said, "The miracle of compounding returns can be overwhelmed by the tyranny of compounding costs." So, wealth builders, you maximize the compounding effect there. Wealth killers, try to minimize the compounding effect there. And again, as you use an example, let's say you've got a 6% return overall on your portfolio. If you're paying 2% fees, now you're down to 4. If you're paying half your return in taxes, you're down. Now that 4% is down to 2%. If inflation is 2%, your net return is down to 0. So you can easily earn a 6% return on your portfolio and end up with 0 at the end of the day. So those wealth killers can cause massive damage. So again, the wealth formula, those 3 wealth builders, 3 wealth killers, those will be the 6 factors that will determine the result of every investment that you make. Keep that in mind, and manage those six forces to benefit yourself to the extent that you can.
Wonderful. Thank you, Larry. So tell us more. Where can we get your book? How can we learn more about it? See more of your work? Of course, we're going to have the giveaway for your book here on the show as well. But for everybody else, tell us more about that.
Sure. The book is called Beat the Bank, and the subtitle is The Canadian Guide to Simply Successful Investing. So again, it's a bit of a wake-up call on what people do, the mistakes people make right now they're not aware of, explain some investing basics to enable people to make better decisions, use lower cost products, and build larger nest eggs. And it is in stores across Canada. It's also available online at Amazon, Indigo, and elsewhere in both print book as well as ebook. My website is larrybates.ca. You can find lots of stuff there, some articles, news stories, and there's also a very useful tool which will show you the impact of the fees you're paying over time. And most people, when they look at that, are absolutely shocked. And very useful tool. The book's also in libraries, and I'm also on social media, on Twitter, LinkedIn, and Facebook.
Okay, awesome. All right, wonderful, Larry. Thank you for coming on and sharing your wisdom with us.
Thanks, Cornell.
All right, take care. Bye. All right, I hope you enjoyed the episode. Don't forget to enter the giveaway for free for a chance to win one of the 3 signed copies of Larry's book. And to do that, just go to buildwealthcanada.ca/beatthebank. All one word. That's buildwealthcanada.ca/beatthebank. And of course, if you haven't already, as a Build with Canada listener, don't forget to get that free 1-year subscription to Canadian Money Saver magazine and double that interest rate that you're currently getting in your checking and savings account by signing up for free to my favorite bank that I've been using for years over at buildwealthcanada.ca/EQ. Once you do that, forward me any email that EQ sends you over to bonus@buildwealthcanada.ca, and I'll send you the coupon code that gets you a 1-year free subscription to Canadian Money Saver magazine, basically a $20 bonus that you're getting for free. You'll also get that extra perk of 5 free Interac e-transfers every month, and you'll know that you're getting one of the highest interest rates in Canada on your savings account. All right, so that link again is buildwealthcanada.ca/EQ. Thank you for supporting the show in that way. Have a great week and talk to you soon.
Thanks for listening to the Build Wealth Canada podcast at www.buildwealthcanada.ca.